Yikes, any optimism that came from the retail sales report this morning faded faster than a hater in bed with his mom. Yeah, take a look at this chart right here. This is the NASDAQ. Yikes, here was our enthusiasm following the stock market open, following retail sales data that was better than expected. Watch my video on that, still very relevant. We posted that earlier this morning. But take a look at this right here at 7 o'clock Pacific time, 10 a.m. Eastern. We had an inflection down that briefly was shrugged off, only for markets to go, wait, no. This is bad. And so let's talk about what that bad was. That bad was the following. The University of Michigan Survey of Consumers. Now, there's some reasons for what just happened here. We're going to try to explain them. But this is not good. This is a pretty not good one. And I'm also going to give some catalyst dates. So buckle up here and make sure you got your life insurance in as little as 5 minutes by going to metkevin.com/life. All right, with that sponsor out of the way, let's get over to this section right here. Year ahead, inflation expectations rose from 3.6% in March to 4.6% in April. The most important thing about this cycle, this Fed tightening cycle right now, what separates us from the 1970s is squarely inflation expectations. If inflation expectations continue to go on this kind of path with the information we just got, we get Paul Volcker again. It's that simple. This is a warning sign of potentially Paul Volcker coming. Now, fortunately, when we actually plot the University of Michigan Consumer Sentiment Survey on a chart and we compare to what it's been doing the past few years, you can see it is a volatile figure. It is volatile. But that downtrend potentially just got broken. Now, keep in mind, these are preliminary numbers, which means that these numbers will actually come in with their final numbers at the end of the month, on the 28th of April. But look at this. We had a beautiful downtrend here. And yes, we've had upticks before. We had an uptick over here towards the end of 2022. We had an uptick over here towards the beginning of 2023. But we've always been followed by these larger downtrends, and the general trend of inflation expectations here has moved down. However, all of a sudden, this large blue line right here represents the sudden explosion of year-ahead inflation expectations going from 3.6 to 4.9%. Now, there's some good news, and that's that long-term inflation expectations came in at 2.9% for the fifth month in a row. And they've been in a range of 2.9 to 3.1% for 20 of the last 21 months. That's great. That means long-term inflation expectations are stable. But short-term, we've just had some volatility. Now, there could be some reason for this. Some folks say it's because of gas prices. In other words, gas prices are trending up over the last few months are potentially leading people to think, all right, here comes the inflation again. Take a look at retail gasoline prices chart. We're sitting at $3.70 a gallon for the week ending April 10th, and that's been on a nice uptrend. It was certainly since March, where we were closer to maybe 10 to 20 cents less expensive, and an uptrend since January, where we were about 30 cents less expensive, so somewhere between 7 to 10% in increases here in gas prices. Some of this obviously has to do with some of the OPEC drama, and that's also something that could weigh on this. So we've got a few things that could weigh on why this sentiment survey came in the way it did. I would first say gas prices. The second thing I would say is the OPEC plus production cut announcement, which basically suggests that oil prices are going to go up, and therefore people think, okay, maybe prices are going to keep going. But this is still a big miss nonetheless. I mean, maybe you could blame the banking crisis, but we didn't see those numbers come up in the final survey for the end of last March. Here we are in mid-April. And so I think the banking crisis is probably, which is like over a month old now, probably not exactly what we're looking at. Probably just looking at gas prices and OPEC. Now, write down this date, April 28th. That's 2 weeks from today. It's not to remind you about an expiring coupon or prices going up or buy now, pay later for the programs and building your wealth link down below. Those are amazing. It's to tell you that that's when the final read comes out on this consumer sentiment survey. And so we'll want to look at that in 2 weeks to see, okay, is this a transitory, dare we say, increase in inflation expectations? Who knows? But this definitely is going to create heart palpitations for the Fed. Now, it is good that you see here rising sentiment for lower income consumers was actually offset by some declines in higher income consumers. So you're getting sort of an evening out of the economy. And while consumers noted easing in some places, you did not actually see any kind of material changes in what consumers thought about the economy. So consumers still had a relatively stable thought about the economy. It's just they think that inflation is going to remain higher for longer. I think that this report, if it holds in the final read in 2 weeks, is probably going to end up forcing that 25 basis point hike from the Federal Reserve. Now, even before this report, I've been a big believer that we're going to see a 25 BP hike. But the price action that you're seeing in the market today, in my opinion, directly corresponds with these higher inflation expectations numbers, because again, this is a big piece of the puzzle in terms of what separates us from the 1970s. And so we don't want to go back to the 1970s at all. Now, it is worth noting that Wall Street mentions the 5 to 10 year median inflation was unchanged expectation. That's good. But this notable pickup from 3.6% to 4.6% is the highest read since November. It's not something that is going to provide any comfort to the Federal Reserve. And if anything, potentially portends sticky inflation, which unfortunately would be the worst case scenario, right? So as usual, in this environment, we're getting a lot of fluctuation in data. And that's actually why I regularly say when we're looking at that Nike swoosh style recovery, you don't want to draw it smooth. You want to draw it like this, because there is a lot of uncertainty in the data, whether it's China, Ukraine, Kevin McCarthy and the debt ceiling. Personally, this is something I want to pay attention to more than some of the other issues going on, because a breaking of inflation expectations is the worst case scenario. That brings us Paul Volcker. Now, the good news is we do have the 5-year break even remaining relatively stable. That's fantastic news, because that's another way of measuring inflation expectations. And the bond market is basically saying, hey, we're not as worried maybe about that consumer survey. See, in the consumer survey, you're really just picking up the phone going, hey, so what do you think about inflation expectations? I think it's going to stay higher for longer. You hear that, it starts showing up in the surveys. The bond market is where people are actually putting their money where their mouth is. And fortunately here, you're not actually seeing any kind of disanchoring of inflation expectations. Now, of course, yes, there's no doubt that inflation expectations were on this glorious downtrend, and the banking crisis broke that trend for a moment. Yes, we've been lower, like in January we were lower here and here. So there have been times we've been lower on inflation expectations, and we really want to see these 5-year break-evens go below 2% in order to actually expect Federal Reserve cuts. So we're not expecting cuts in rates until these break-evens trend down even more. And we're making progress. The break-evens are down a lot. Fortunately, the break-evens are not spiking on the result of this consumer survey. That could be a way of the bond market saying, hey, look, maybe consumers are worried, but we're not. The 5-year break-even inflation rate, nice and stable. Little bit of a tick up, tiny little bit of a tick up, but again, when you look at the broader trend that we're seeing here on the on sort of the daily chart, rather than looking at it by minute, you look at the daily chart, the trend is clear. Yes, maybe you had a little uptick there on the right, but really, does that change any of this? No. So broadly, should we be nervous about this? No. Is the market going down because inflation expectations came in hotter, and that's one of the things we definitely don't want to see happen? Yes, absolutely. Fortunately, other leading indicators of inflation are really suggesting deflation. This morning in the course member live stream, we went deep into Fastenal, and we see nothing but deflation written all over the place. Deflation, 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 which is great. That's an industrial supplier for construction. You look at CarMax, we see deflation. Most of the companies that we are analyzing, there are very few, pet store is probably the exception, but most of the companies we're analyzing, are expecting price declines and disinflation, if not outright deflation. Now, of course, we're not yet expecting prices to show up cheaper in grocery stores or whatever else. So on the day-to-day basis, it may feel like prices are still high and staying high, but that is how inflation works. Prices went up and they stay up. Now the goal is let's prevent them from going up again. This consumer data hurt a little bit, but as I've mentioned before, you can still get life insurance in as little as 5 minutes. Thank you so much for watching the video. Go to metkevin.com/life. You could Apple Pay or Android Pay for it. And folks, we'll see you in the next one. Goodbye and good luck.